Hey all, how you doing? Jason Lawrence here. I'm going to be doing a video series for those of you that are going to be building homes. And if you're generaling it yourself, if you're going to be finding a home builder, even if this is a spec home you're going to be building yourself, I think this is all relevant information. And I'm going to call this Building Smart: How to Choose Your Builder and Avoid Costly Mistakes. One of the main parts that I'm going to focus on in this series, not in this video, but in the series that I'm going to do, is choosing your builder and comparing builders, because that's one of the hardest things to do, is finding the right builder. And really, choosing the right builder is a huge part of the success or smooth building experience that you can have. If you choose the wrong builder and you don't look closely at things, you can be in for a really bumpy ride. And not only that, not only just a really long drug out build time, but you could end up being way over budget and just not really having a great experience. So there's certain things that you need to look for when you're choosing a builder, and we're going to get to that in one of the future videos, but we're going to kind of start from the beginning here. I'm going to go through the whole process. I've actually put together a course that's called Smart Home Building: Choosing the Right Builder and Avoiding Costly Mistakes, and I'm going to follow the outline of the course. And in this course that I put together, there's a 50-page handbook that guides you through the process. There's a checklist in here for comparing floor plans. So if you're meeting with multiple builders and you're getting prices from them and you're wondering, well, why is his model so much more than her model? Well, you can take the two floor plans or flyers that they have, and there's a checklist in there that's going to call out all the things that you need to look for. Counting the amount of foundation corners, writing them in there, counting the amount of windows, writing them in there, and then you'll be able to see why one plan is more than another. So there's all kinds of great information in this course, and really the course is going to be less than the kitchen faucet that you're going to be putting in your house. And if you're going to be spending hundreds of thousands of dollars on building a home, I would really recommend investing in something like this that can help guide you through this process. I'll put the information for the course in the description of the video so you can check it out. The first thing that you're going to be doing, or that you should be doing, is establishing your budget. You don't want to go out there and basically waste time and start looking at different lots, different builders, different floor plans, and not really know what you can spend. You may fall in love with something because you're kind of looking at everything, and it ends up just being way over the budget that you're able to spend, or way past the amount that a bank is going to lend you money for. So one of the first things that you should do, in addition to starting to get your feet wet with going around to different builders' models and looking at lots and things like that, would be talking with the bank. And now you could maybe go to a builder's open house, and they probably have some lenders that they're going to recommend. That's probably a good idea. The local builders are going to know what banks do construction loans, so they'll be able to point you in the right direction there. And what you're going to want to do is simply, like if you were going to be buying an existing home, you would get a pre-approval from the bank so that what price point homes you should be looking at. It's the same thing with building a new home. You're going to go to the bank, and you're basically going to find out, not just, okay, what's the maximum that I can borrow, because you may not be comfortable with that payment either. The bank may say, well, we can borrow you $800,000. Here's what the payments are. And you may look at that payment and say, well, then I'm not going to be able to do anything else. If I build the $800,000 home, we're not going to the movies anymore. We're not going on vacations. We're not going out to eat. So you may say, okay, based upon what the payments are for $800,000 home, that's not going to work. I think we want to, stick around 700 so that we're more comfortable. Basically, you want to know what that amount is that you can borrow and what those monthly payments are going to be. That way, when you start the process of going to the different builders, you know what price point you're looking in. And it's really helpful. I mean, to be able to go into one of the first questions that I ask if somebody comes in and meets with me is, what's your budget? A lot of times at that point, a lot of times people don't know yet. That's why it is good to go to the bank first. But it's nice for me to be able to say, okay, your budget is, $700,000. Okay, what are you looking for in the home? How many bedrooms, bathrooms do you need? And then I've already got an idea of, okay, this is the size home that's going to work for them. Here's a few different floor plans that can work for them. That's going to kind of streamline your process and save time there, because myself as the builder, I'm going to be able to present you with some options that are going to work in your budget, as opposed to you just telling me what you want and I come back and I'm like, well, here's this amazing 3,500 square foot house. It's got everything you need. And we spend months going through the process, and you spend time doing selections and this, that, and the other. And then we come back to you and say, okay, well, this is what the price is going to be, and it's way past what you want to spend. And now you could have just wasted, 4, 5, 6 months. Depending on how long it takes for some of these builders to price things and get back to you. So the construction loan is a little bit of a different type of loan compared to if you were going to be buying a house, an existing house. If you're going to buy an existing house, you're going to get the pre-approval, you're going to write the offer to purchase, you're going to have a closing where the bank is going to fund the entire purchase at that closing. With a construction loan, it's a little bit different. You are going to get a price from the builder, and we're going to cover all this stuff in videos to come, because everything that's in the course here is kind of leading up to that point in which, before you give the bank the building contract, you need to make sure that this is accounted for and that's accounted for, and you've done this and you've picked your selection, and basically you've done everything that you need to so that yourself and the builder has all of the information pertaining to what you're going to be doing in the home, and then they can take that and put that into a building contract that has an accurate number, so that when you go and get that building contract and you close on the construction loan, the goal is to limit the amount of overages that you're going to have, or payments out of pocket that you're going to have to make. Now, sometimes these things are unavoidable. A lot of times, if building on pieces of raw land, and when I say raw land, that would be something that's not in a developed subdivision. It's on a farm field or a wooded lot. But a lot of times there's things that come up there where they had to dig the hole a little bit deeper to hit compactable soil. And because of that, they had to do taller foundation walls under the porch and taller foundation walls under the garage. And you needed to keep the elevation up. So those walls are sticking out of the ground 3 feet, but then they're deeper than normal too. So now you've got 8-foot miniature basement walls under the garage, as opposed to a 4-foot wall that would just kind of be standard underneath the garage. And so you've got the extra expense of the wall. And then if your foundation's sticking 3 feet out of the ground, they typically are going to dig around the perimeter of the garage and leave all the dirt in the middle. But now you've still got this big void between the top of the wall and the ground. That's going to need to get filled in with stone. Those two things right there can end up being a few $1,000 to $10,000. And it's really hard to know if those things are going to come up. There's things that you can do ahead of time, like survey work and things like that can help limit what that's going to be. And again, we'll cover those in future videos. But basically, you're going to get to the point where you've got a building contract with the builder. You're going to give that to the bank. The bank's going to take the building contract, and at this point too, you're going to have blueprints. In order for the builder to have given you an exact amount for the building contract, you need to have a full set of blueprints. They needed to take the full set of blueprints, price it out, know exactly what you're doing in order to give you an accurate cost. If a builder's ever trying to get you to go to the bank before you've got a blueprint or before they know what the exact cost is for that, that's a bad idea. Don't do that. Wait until you get the full set of blueprints so that they can be priced out and you both know everything that's exactly going to be in the home. But the bank's going to take the building contract, they're going to take the blueprint, and then they're going to do an appraisal on those two things, just like if you were buying an existing home. Before you close on an existing home, the bank's going to send an appraiser out to that home, and the appraiser is going to do, look at sold comparables and other things like that, and he's going to tell the bank that yes, the purchase price for this home is in line with what it can sell for. That way the bank, when they fund the sale, they know that they're making a good investment. They're not borrowing you more than what they could get back out of it if you defaulted on the loan. So they're going to do the appraisal on the blueprint and the building contract. They're not able to walk through the house, so sometimes your build may appraise out for less than what the building contract amount is, especially with where building prices are right now. And a lot of it is because they can't, they're looking at a blueprint. So you may have this amazing home, 12-foot ceilings, transom windows everywhere, big tile shower, and they see that on the print and they can read it in the building contract, but it's not the same as if they were walking through the house and like, wow, this is amazing. And they justify to themselves the amount because they're in the house and they see that it's wow. They see all the finishes. It just makes for a better appraisal. So a lot of times what happens is your construction loan, when they're taking the blueprint and the building agreement, it's going to appraise out for, exactly what the build cost is. Sometimes it could be less, sometimes more, but most commonly it's going to be kind of right there to match up with the contract price. And then after the build is done, if you're going to be converting into another loan and there's another appraisal that takes place, usually at that time the home is going to appraise out for more because now they're walking through it, and again they're, wow, this is amazing, and the feelings that they're having are going into the value that they're giving. So they're going to do an appraisal on the blueprint, on the building contract, and then they're going to go back to the bank and say, yep, everything's in line as far as the amount that they want. It matches up with what's being built here. And then you're going to close on the construction loan. So once you close on the construction loan, let's just say your build is $500,000. And maybe you put, some of that already down with the builder, but that $500,000 is going to go into an escrow account either at the bank or at the title company that the builder and the bank are using to do draws, and we'll cover that in just a second here. So all of the money goes into this escrow account so that it's, all the money there to build the house is there and available for the builder. Now the builder is going to take 5, 6, maybe 7 draws depending on the size of the house. And usually that first draw is going to take place right around the time that the foundation is done. So they can pay for the site work, they can pay the foundation company. They're going to send you something that says we're going to be drawing $45,000 to pay, these 3 contractors. You're going to sign off on that. You're going to go to the site, make sure that it's done. The title company is also going to do that too. They're going to have somebody come out and look and verify that that work's been done before they release the money to the builder or to those contractors. They're either going to release money to the builder and the builder is going to pay the contractors, or they're going to release money to the contractors. And either way, lien waivers are getting signed before the contractors are getting money. So that way and that's something you may want to ask your lender about and verify, hey, before anybody gets paid, I just want to make sure they're signing a lien waiver. That way you don't get to where your house is done, you're living in it, and then a month later, you get a lien slapped on the house because the roofer said that he didn't get paid, or he didn't get paid the amount that he was supposed to. So you're going to have that first draw there. The second draw is going to be right around the time that the framing is done. So they can pay for the lumber, they can pay the framer. The third draw is going to be after all the rough mechanicals are done, the rough wiring, plumbing, HVAC, fireplace rough. They can pay all of those contractors. You're going to be making interest payments once a month. So whatever your construction loan rate is, you're going to be making a payment once a month based upon the amount of money that's drawn. So in the beginning, when they just took that $45,000, you're making an interest-only payment just against that $45,000. So it's a small amount. As the amount gets bigger, they take another $100,000 now that framing is done. And so now the amount that you're paying interest against is $145,000. But these payments are still going to be smaller than what a full-on mortgage payment would be. So for a lot of people that are building, they're able to go to the bank, and this is something you'd kind of find out in the beginning, along with the amount that you're approved for, as to whether or not you need to sell your home in order to build. A lot of times the bank can look at your home and say, okay, you've got some equity in your house. You can stay living in your home until the new one's done, and then you can put your existing home up for sale and sell it. And that works out great so that you don't have to move twice. You can have the build going on, and then when that gets done, you can move from your existing home into the new one and then sell your existing home. The fourth draw is going to be right around the time that drywall is finished. And then that fifth draw is going to be the final draw. Now, again, if this is a big custom house, there's probably going to be, the builder really needs to be getting paid. It's unrealistic these days for it to be, once a month. But I mean, once every 2 months, they're needing that for their cash flow to be able to pay contractors. As soon as somebody's done with their job, the drywaller's done drywalling the house, you can guarantee that the drywaller is asking for payment from the builder the next day. Now, the builder has to put that draw together. There's a lot of paperwork that goes together, figuring out the amount. So, one tip I would kind of give is, when the builder sends you the draw, be ready to sign the draw, and know that the builder can't draw more than what's in your escrow account. If he's the build's $500,000, that's what's in your escrow account. He can't take more than that out of there. So these amounts that are coming out, you're not going to receive, in most cases, a full breakdown from the builder saying this is the exact amount that we're paying him for, or we've got this draw where we're paying for cabinets, we're paying for the trim carpet, this, that, and the other. This is how much every cabinet costs. You're not going to get that information most of the time. The builder's just going to say, this is the amount that I need. These are the items that have been completed. And again, you're going to just be checking to make sure those items are done and completed. So yeah, that's kind of the draw process. Now, when the house is done, depending on the construction loan that you've got, you may be able to just automatically convert that into a 30-year fixed. These days, because the interest rate, and this is 2023, January, beginning of the year, interest rates are higher than they've been in the last few years. So a lot of people are doing maybe a 5, a 7-year, or a 10-year ARM for their construction loan. And the reason that you're doing that is, so let's take the 10-year ARM. You can go into the bank today, you can get locked in for your 10-year ARM rate, which is, we'll say, 5.5%. And now you don't have to worry about what the interest rates are going to be a year from now when your home is completed, because they may be 6.5%, but you're already locked into that 10-year ARM. Now you're kind of banking on I shouldn't say the fact, but you're banking on rates coming down in the next few years, or at least staying where they're at, so that at some point before that 10-year mark comes, you're able to refinance or just take that and convert it into another type of loan for a lesser rate or the same rate. Same with the 5-year, except you've got 5 years instead of 10. So a lot of people are doing that, because otherwise, if you're getting just the basic construction loan, which would be like a 1-year loan, you get that construction loan, and then when the home is done, you need to convert into a 30-year fixed. So if you get your construction loan rate now and your house takes a year to build, again, you don't know where the interest rates are going to be a year from now. And so say they're up at 7%, well, now you're getting that 30-year fixed at 7%, whereas you can just lock into something now with a different type of program for a lesser rate. For example, another type of program that's out there, and all banks are different. So you want to kind of shop around with different banks. In our area, there's one particular lender that offers a 30-year fixed at the time of closing on the construction loan. And I think that rate is like, 6.23, but you're able to get locked in to 6.23 before your home starts. And then when your home's done, that's your 30-year loan. So you know that you're getting 6.23 and you're not gonna have to worry about it. Now, say you build your home and in 5 years, the rates come back down to 5%, you can refinance that into a 5%. You don't have to stay in that 30-year fix. So that would be some of the things that you would want to talk to the bank about and see what type of options they offer. All right, well, that's going to do it for this video. That's kind of the overview of the series and the course that I have. I'll put the information for the course in the details of the video. And this is pretty much step one. So the next video that I'm going to do is going to be about finding your property and what to look for, and then we'll just continue through the process from there. So I hope you enjoyed this video, found some things useful. Thank you for watching. Take care and God bless.